Hello, this is Brian Resney, President of Resney Wealth Management. I'm bringing an important update about the economy and the investment market so you can see what we see in the global landscape. Well, of course, the second quarter is over, and generally speaking, earnings that have been coming out with most corporations, about 70 to 75%, are actually beating. That means corporations are growing earnings, they're growing revenues, and generally speaking, the stock market's up year to date. When the quarter ended, though, the S&P was actually down just a little bit year to date, just a little bit. Bonds, on the other hand, especially intermediate and long-term bonds, were actually down between 3 and 7%, negative 3 to 7%. I'm glad to say our clients at our firm actually did quite well. Most of our clients were up positive or slightly negative, outperforming the benchmarks, not only of the bond market, but the stock market. We continue to hold positions in our favorite areas that are relatively strong. We will be making some adjustments shortly, in my opinion, in the bond side of our equation, because I firmly believe we're going to see some type of interest rate increase potentially in September, certainly by year end. A lot of that, though, is predicated on employment, which has been positive, but the other mandate with the Fed is inflation, which has been very, very low, well under 2% from at least running numbers for 2015. The economy is chugging along. People are spending. We're starting to see a little bit of wage inflation, which is net positive. This means people are making ultimately more money. Ultimately, more money in wages usually increases GDP. Ultimately, when you see unemployment like it is right now and getting a little bit better and actually under 6% unemployment numbers, that again bodes well for the U.S. economy. We continue to avoid areas like intermediate and long-term bonds. We continue to avoid the emerging markets and other markets around the world because they've been relatively weak. There's been a lot of hoopla as of late about China, and China's markets are down about 35 to 40% in just the last 6 to 8 weeks. We continue to avoid China right now, and we continue to be out of the emerging markets. So if I kind of look at the scorecard as of today, bonds, intermediate to long-term bonds, mostly are negative year to date. The S&P is now up about 2%. Small caps are outperforming large caps, as I talked earlier, and so are mid-cap outperforming large cap. We continue to not have any weighting in emerging markets, which tend to be negative most countries year to date. So we're in exactly the sweet spot. We like where we're at. We will make fine-tuning adjustments as necessary, but one of the things I try to educate every client and every investor, not every quarter is up. Sometimes you can go through one quarter up, one quarter down, another quarter up, another quarter down. You might end the year down 1% or up 3%. By the end of this year, I firmly believe we will have some nice net positive numbers, but remember, quarter to quarter, nothing is consistent. We actually ended the quarter again, if you look at the S&P, negative slightly. That's the broad market index. And if you look at bonds, most were negative substantially year to date as the quarter ended. Our clients, of course, did quite well. If you're a client of our firm and you have any questions, please call our office. If you're not a client of our firm, call us for a consultation. It's time you became a client. At least you got a second opinion. Make sure you have yourself a safe and profitable day.